Goldilocks was this idea that we had a not too hot, not too cold economy that could operate with some slack. I think the slack has been removed, and so this would play into the portfolio construction, how you mix stocks and bonds. For the last 20 years, every big stock market decline has been accompanied by a decline in bond yields. Maybe that doesn't work as well. Didn't work that well for all of last year. So I'm not sure the correlation there has to flip, but maybe it declines significantly. Maybe it goes to zero there. So I'm not sure we're going to get that same hedging ability. I'm not sure we have an economy that's in this Goldilocks regime anymore. I think we should think about going back to some of the models that existed before deflation became the big concern. Even in Japan, if we look abroad, the price level has stopped going down. So if we take some of the data that we could use for confirmation purposes, even there, we don't see deflation as the big risk. So making that sort of transition, we think is important. It's important to acknowledge that turn in inflation, but we don't want to get carried away. And I think jumping to recession as a base case here is starting to get carried away. Also, the equilibrium interest rate that we would think would persist in the economy is probably lower than some historical episodes. We used to see the Fed raise the Fed funds rate to 5 or 6%. I don't think they're going to get that far. If they get to 3 or somewhere around 3, I think they'd call it a day. So if we were to think about where we go from here, the additional cushions for this year come down to a few for us. First, we have tax refunds. We also have lower oil prices right now. And if we can see housing stabilize with the Fed pause, that will matter. A transition to capital spending is key. The Dallas Fed has done some work saying $50 oil is a key break-even point for investment. That has come out of some of the surveys. We think that does matter. We're holding those numbers thus far. So if we see CEO confidence stabilize, if we see consumer expectations bounce back, that can matter. So I'll end with a list of things that we're watching. If we wanted some items to put on the risk list, I'd say we have to keep the government open. We need to see the domestic stimulus in China outweigh their deleveraging. We need to see a US-China trade deal. We need to see a Fed pause. We need to see stable oil prices. Perhaps OPEC could play a role there. We need to see Brexit go okay. We need to see the Japan VAT tax increase that's planned for later this year go okay. There are a couple US policy items. We care about policy, not politics. Here, we'd watch the debt ceiling and we'd watch the sequester budget cuts that are in defense. But we think on all of these, they're most likely to go right rather than wrong. Growth is still positive, it is slowing, but recession is not the right starting point today. So thank you.
Don, Nancy, thank you. Our State Controller, Ms. Shi.
Thanks, Harry, and thank you for the overview and perspectives. I had a question about wage growth, and obviously it's music to a lot of workers' ears, having not really seen real wage growth for quite a period of time. But accounting for inflation, I guess how real is that wage growth, and does that really, I guess in terms of purchasing power for workers, what does that truly look like today?
You have started.
It's your mic, Nancy, sorry.
Sorry.
You can leave those on, Don.
Oh, okay. Thank you. So that's where the unemployment rate going from 10 to less than 4 is so important.
Yeah.
That incrementally means now the demand for labor is starting to exceed the supply, and incrementally you can see wage inflation creep. We've started to see it. You've gone from roughly something less than 2 to 2.5. Now we've moved up to 3. At a point, at least as of now, inflation actually is slowing in the first part of 2018. So you are incrementally getting some wages. I think, I'm sure Don has some things to comment on that. That's where I would argue that through this positive investment cycle that we're seeing, it's not just wage growth that matters. It's an incremental person getting a job. Income growth, real family income growth is increasing and has broken out on the upside. Mm-hmm. And that is a very, very important point. But maintaining health of corporate America, again, I give you Europe, where they have incredibly aggressive some people would say attractive social safety net, labor laws supporting the worker, they can't get that unemployment rate down. So that's why I said at the very beginning, look at the world differently. We've had tremendous headwinds on our labor market. We stopped investing, people couldn't get jobs, destroyed real median family income, and now that's starting to change. I think we are moving in the right direction, acknowledging we have a lot of work ahead of us.
Yeah.
But what we don't want to do is end up like Europe.
Right.
Just a quick comment, there's been this debate on the Phillips curve and some of these historical relationships. It hasn't worked that well in the past decade. We may be getting to a point where the Phillips curve is a bit more relevant, may not have returned to its historical relationship, but you are seeing unemployment rates that are finally low enough to start to get those wage numbers up. Maybe there's more room to go. I think that would be something we should see at this part of the cycle. We would really care about the productivity adjusted wage, the unit labor cost number, when thinking about whether that's a cycle factor, though. So I just point that out as well.
Thank you.
State Treasurer, Ms. Ma.
Thank you very much. Thank you, because I consider that positive. I'm sure Controller Betty Yee and I are like so happy to hear your prolonged projections. But, you know, a couple things, obviously, you know, of concern: healthcare, Social Security, unfunded liabilities, high student loan debt, all the things that, you know, people like to talk about. I can see how perhaps some of them can be prolonged through your rosy projections, which I thank you very much. The federal deficit is something I would love to hear your thoughts on. How do we get out of that predicament?
So I'd be happy to offer a couple thoughts there. So of all the problems we have right now, high interest rates aren't one of them, fortunately. So if we took the snapshot of our debt picture, there's no immediate concern, at least at the federal level, given the interest rate profile. So that doesn't mean we shouldn't be thinking about it, of course. When we look at where some of the big spending is going to come from, healthcare is a big factor. Social Security would be another one. Social Security at least looks analyzable. And if the goal of the program was to keep elderly people out of poverty, I think the program can fulfill that mission. There may need to be some changes, but that can be done, I would argue. Healthcare is trickier. Healthcare is trickier because we keep discovering new things. We don't seem to have a healthcare inflation problem. We have a healthcare spending issue. It's not that each test is costing more, it's that we keep discovering 5 new tests. And as you pay in, what you take out of that system is bigger. And so at some point, I think we have to address that. I know of nothing that is moving right now that would fix that problem. But if I were to say where we should focus our attention, it's on the medical spending side and how we're going to treat that over coming decades.
I agree. The only thing I might add is on the Social Security side, we had an issue in the early 1980s. Greenspan at the time was ahead of the commission, and what he did was increase the age over 30 years in which your Social Security funds would be paid out. Painless, and it worked. And so it's clear we need some reform, easier said than done. I think we've dodged it this expansion, but potentially the next expansion, we will need to deal with it. And history would suggest, I agree, the healthcare is more difficult, at least on Social Security. There is probably a way to deal with it, but we just aren't yet at that point, but potentially the next expansion.
So we don't have to worry about the federal deficit at this moment. Is that what I'm hearing?
Well, look, the market is saying no, right? The market is saying that the U.S. is still a source where funds will flow. And sometimes this is described as we have the reserve currency. For better or worse, we seem to have the reserve currency. So that lets us attract a large share of the world's capital at a really cheap interest rate, a really low interest rate. That's working for now. Of all the problems we have, that's not the most immediate.
Is that it, Ms. Ma?
Yes.
Okay, thanks. Paul?
Thank you. So very interesting. I appreciate very much hearing what you had to say. and obviously we care about what's going to happen in the economy in the next 1 or 2 years. We're also care a lot more about what's going to happen in the economy long run. Because what we know is we get into trouble when things get really bad in the economy. And so, you know, I'm sort of reminded back to when I studied economics, which was not as sophisticated an endeavor as the two of yours, but it was really clear that you could always get an improvement in the economy by cutting taxes. That's sort of fundamental fiscal policy, right? So we have a lot of economists like Paul Krugman now who think we're just on a sugar high from the tax cuts. I'm assuming you don't think so. But I wonder, because in hearing your conversations, there were a lot of things that were maybe mentioned a little bit, but didn't seem to have sort of a central role in the picture you described, such as, you know, we've had a very sluggish recovery due to a very sluggish growth in productivity, which means that it's been a recovery that's gone to capital rather than to labor. We've had a tremendous increase in income inequality and wealth inequality. We've had a tremendous increase in the federal deficit at a time, at least when I learned economics, when you're pretty near full employment, that's when you don't increase the deficit. But we've got now, you know, debt that's $1 trillion or more. And my question isn't to question your description of the environment today, even though there are a lot of people who see it differently, but to question whether things like increased income and wealth inequality, whether stock buybacks, whether slow growth in productivity, whether tariffs, all of these, and the growth in the debt, whether that's going to make it harder for us to respond when we do go into a recession. In other words, where will that leave us as we do go into that inevitable recession, whether it's 1 year, 2 years, 3 years from now? Is that going to make it harder for us to respond and get out of the recession?
So maybe I'll start first and highlight that I agree with your focus on productivity. It's key. Productivity peaked about 2004, if you look at it on a smooth basis. And there are two, if you want to really simplify the U.S. economy, there are two main drivers of growth: productivity and labor force growth. That's it. When you look around the world, it's really important in any country to understand what has been and maybe what will be the path of those two things. So for over a decade, we've had a deterioration in productivity. The housing boom did not improve productivity. Productivity deteriorated. And again, it was because we stopped investing domestically and we were investing outside of this country. So there were really three reasons for the new normal growth trajectory, where GDP growth shifted down to 2% for at least the first part, if not the bulk of this expansion so far. Not just one. Classically, there's viewed as one reason, and that's the unwind of the debt bubble. It is a reason, it's just that it's not the only reason. The second reason was we stopped investing, and you shift down what we call in my world potential GDP growth, kind of the core growth rate of an economy, if you don't invest. So productivity growth went from 3.5 to 0.5 over roughly a decade, 14-year time period. Darn tootin', you're going to pull down potential GDP growth. And at the same time, you had an unusual shift down, as I talked about, in labor force participation rate. Drove the Fed nuts. Janet Yellen, you just would constantly scratch your head at that. So you had three major headwinds to this economy, shifting growth down from kind of a more average 3.5% expansion to 2%. And every year that happens, to be sure, you destroy jobs, you destroy income growth, and you end up in the pickle we were in. That's where we would say, and I apologize for repeating myself, you've got to start to maybe look at the world a little differently. Because Now, productivity is shifting up. I spend a lot of time on productivity. And our models tell us it's bottomed at 0.5, and last year was 1.3. We're moving to 1.5, maybe even 2 over the next several years. I agree with you. I think you do have to look longer, which is why I'm not pounding the table of a recession even in 2021. You get that shift up in productivity, you then start to deal with some of those structural weak spots in the economy, such as income inequality. It's through jobs that you fix those. You fix those issues. So I would argue that's where we've been. Totally agree. It's been pretty darn sad. And now we're at potentially an inflection point.
I just add one data point. We can look at gross domestic investment in the economy, and then there is a series on depreciation that we can subtract from that to get a net domestic investment number. Whereas gross domestic investment has continued to rise, we're really just keeping up with depreciation for the last decade. So our net domestic investment for the U.S. economy really has not risen that much in the past 10 years. The type of investment we're doing is things that depreciate quite quickly, and that likely has been part of the problem. The way I'd interpret the tax bill, and there probably is some sugar in there, but it's not all sugar. There is the corporate tax cut, which was reasonably well designed, and the goal there is to get the CapEx up through an incentive, whether it's accelerated depreciation or bringing money back from abroad or a lower tax rate or all three plus. And then you get the CapEx that gets you the productivity pays for higher wages. That's the plan that we have in place right now. That's why we're upping the budget deficit early. We could say we have pulled the trigger on this bill in its entirety and maybe you needed a little sugar to get it passed. But it's CapEx to productivity to wages that should determine the length of the cycle more broadly. Something on the tariffs, I think we could make the case the trade has not been fair. I would simply debate whether a tariff is the right tool to deal with that. I think I would argue probably not. There may be some other ways we could shift to over the course of this year. In terms of income inequality, there was a book by an economist, Thomas Piketty, about income inequality of 700 pages. It's translated from French. It was a bestseller on Amazon in the last couple of years. So it's clearly striking a nerve, this issue, and I think it is something to be considered. And it's the mix of policy, whether it's monetary or fiscal, that I think will help determine that.
So if I could just, what I think you're saying is that the corporate tax cuts, in your opinion, the corporate tax cuts are making structural changes in terms of developing, getting more business investment. More business investment is increasing productivity, and that will put us in a better structural place to come out of the next recession. In other words, it's going to, your feeling is it's going to make things better rather than worse in terms of our ability to respond?
Yeah, and I would just echo what Don said. You've actually started to already see that investment in the United States. I'd say there are two important drivers of that investment. One, it's no longer attractive, quite frankly, to invest in China. And that actually started back in 2014. And so you've already seen an increase in this capital stock, kind of this net investment in the United States. It troughed back in 2014 as China was starting to unwind their excessive investment. So you have really two forces, which increases the odds that there's some truth to this path. You had one, the global economy has changed. You no longer just put everything in China. If you sell it here, you make it here. That's becoming a little made in America. I'm sure we all know people who are doing that. So you've seen an investment shift even prior to the tax cut with this incremental shift up in the growth in the capital stock. And now you have this corporate tax cut put in place. So you have seen this shift up in productivity prior to the tax cut because of this shift in globalization, and this tax cut increases the odds. And yes, I agree with the way you summarized it, that if we were still only growing 2%, I would be very worried about the next recession. And so the fact that we're shifted up some from that increases the odds it won't be as bad. China may actually be the epicenter of the next recession, and not the United States.
Thank you.
Just one final comment. There has been some hesitation in the last couple of quarters, which looks tied to CEO confidence and that could be tied to uncertainty over trade. It could be the government shutdown. So it looks to be the case that we have started in this direction and then we created our own pause. We created some self-inflicted wounds in the last couple quarters. We're assuming that those get better, not worse, over the course of the next year, and then those incentives come back.
Paul, anything else?
No, thank you.
Was that a?
Yeah.
Please, Alan, from PCA and Stephen or Mika, we've got a few more minutes. We've got about 4 or 5 more minutes in our time allotted.
Two different questions with the same theme. One is if you would try to do a link between your basically positive economic forecast and what you see happening in the capital markets in a relatively short time, let's say 1 or 2 years. And number two, the impact of populism on capital markets just more generically as opposed to anything specific.
So on the capital markets, one of the most important drivers is the, again, I apologize, is health of corporate America. Within, you had a lot of volatility in 2018, and we would argue a lot of that volatility was, to be sure, I agree with Don, in part by Washington, but also by China. And if Washington is moving a little bit less in the extreme direction, government shutdown is done, hopefully it won't happen again, trade some incremental progress. China, we would argue, has eased pretty aggressively. They've eased very aggressively. They've cut rates 200 basis points, they've increased government spending, they're cutting taxes just very recently, and that's gonna help boost and ease some of these global business expectation fears. And so going into 2019, we would argue their business confidence, consumer confidence, which have gotten hit domestically, globally, actually starts to recover as our government gets a little less volatile and the China economy starts to improve. So we would, and the fact our recession risk index, which we also use as a way to help gauge what the underlying trend in equity markets should be, also tells us to have a return this year of 10 to 15%, given economic fundamentals, barring something coming in from a political perspective, wouldn't be unreasonable.
And on the populism issue?
I really don't have a comment on that.
I might just add, I think the idea that the interest rate the economy can take is different than the interest rate that's making financial markets consistent is what's generated a lot of the volatility, especially in the last 6 months. Those have to converge. I think if they converge slowly, say 25 basis points every 6 months, something of that magnitude, that this can be done. I think the Fed gets it, and I think they can get it right. In terms of other policies, it's really earnings and interest rates that are going to drive the capital markets. So that's why we focus on policy, not politics. So politics has been messy for a very long time. I don't think that's all that informative here, but it's allowing those things to play out slowly that we'd watch most closely.
Yeah, go ahead. Last one, Alan?
Just while you were speaking, the Fed said they weren't going to raise rates and they were going to be more patient. So the forecast that you indicated earlier was right on the money.
Good.
That's good. So we're up against our time slot. I thought your presentations were clear. You certainly have a view. And
My daughter
I
tells
like
me that, too.
optimism personally, and when it's backed up with data, it's helpful. You know, I've heard a lot of people commentators, economists, pundits, people speaking for an extended period of time, often talking about where are we in the cycle, what inning are we in. Wouldn't it be nice if we were in the early innings of a doubleheader? Wouldn't that be terrific? Ernie Banks said, let's play 2. At the same time, there's a lot of reason to be cautious, and not the least of which is some of the policy making and the decisions that are coming out of different parts of Washington, D.C. And I do think, as we think about our asset allocation mix and decisions we're going to be making over the next few months, we do have to think of the world. For me, I have to think about the world and where growth is going to take place, not only in the next year, 2 or 3 years, but the next 5, 10, 20 years. And I think it's hard, you'd have to be hard pressed to say that growth will not take place and consumption won't take place in other parts of the world. All you have to do is spend a little time in Hong Kong and to see what they're doing with consumption. But interesting, stimulating, thought-provoking conversations certainly influence my thinking on the issues before us. And I really do appreciate that you have views and you expressed what your views are based on the research and the work that you do. Christopher, last comment.
Very short. Before you leave, can you share in your mind with the board what one economic statistic they should generally keep an eye on in their busy lives? What stat of all the things that come out?
I would say what I started with, which was unemployment claims. They reflect, obviously, the job market, but they also reflect business confidence and what businesses are actually doing. It's a long-held economic statistic, one of Greenspan's favorite historically. It's volatile, we smooth it, but unemployment claims.
Yeah, very good. I mean, what's interesting is the labor market and capital spending correlate positively. So we, as a whole economy, generally have jobs growing and capital spending growing at the same time. So this idea we replace labor with capital may happen at an individual level, but somebody else has to make that machine. So data on the labor market, whether it's claims or whether it's payroll employment, which drives a lot of the market volatility, is very important.
Thanks.
Thank you.
We take a 5-minute break and then we're going to come back with the next item. It's about 7 minutes. At 5 to 12, we'll start the next item. Item 5 is the asset liability study, step 1. I think it's at least a 6-step process, multiple meetings. This is meant to be high level, the initial step in a multiple step process, where at the end of it, we will make probably our most significant decision in terms of what our asset allocation will be. But so please keep that in mind, that this is only the initial step that will take probably at least a half a year before we get to its conclusion. We have a group of presenters. I'm going to ask that the presenters go through their presentations and we'll take questions at the end. I think Geraldine, you're going to lead this. Is that correct? You're going to introduce it?
Yes, I am.
Thank you.
So, again, Geraldine Jimenez, staff. I, as well as Josh Diedish, are part of an ALM team, Asset Liability Management team, that includes our actuaries and our fiscal services branch. So we are working as a team. So what I tell you today, they have heard, we've discussed with them, and we will continue throughout the year. I think that's really important to understand. There won't be any surprises on either side. So I wanted to open it up and give you an overview of what the next year will look like to kind of help you understand the pace and maybe where some of your thoughts might be addressed and concerns and discussions. So after today in March, we will be back and we will group major asset classes together. So an example might be equity. So equity, we have public equity, we have private equity, we have international, domestic. So we'll group these and we'll talk about any constraints, kind of in general high-level outlook and what these different groups look like, because these are the building blocks of the asset allocation. And then in May, we'll come back with more specific on these different groups and talk a little bit about the type of returns, type of risk, maybe how these groups behave together, because obviously some will be going up while others will be going down, depending on the market environment. And we want to queue up also key decision factors. And this is really important. We're looking for input from the investment committee on things that you think are very important for us to consider with each asset allocation. And I list a couple there. Some of them will just jump out at you. Risk to the funding plan, risk to contributions, volatility on contributions. So we're going to really look for input from you on things that are important, because when we go back to model, we're going to think about those things you said are important, and we'll work with the actuaries to model it on different portfolios. So then we get to July and we will come back with those models and it'll be just an array, very preliminary, just again to get your input. We're looking for a lot of discussion among the investment committee. Again, we'll queue up these different portfolios, the different key decision factors, and again, look for your input. So September, you'll continue this discussion, yet we're going to really refine different portfolios based on the input you gave us and based on those key decision factors. And we're going to hear what you say and then hopefully really refine what you're looking for, because when we come back in November, it's probably one portfolio or two. Hopefully we really narrow down what the risk trade-offs you're looking for in this asset allocation. Because in November, we're looking for that and a decision by the committee on which portfolio you think best meets your needs to fund our benefits. And then in February, to really document it, we're actually going to come back with the policy change. In that, we will also talk about any implementation plan. If you recall, when we had risk mitigating strategies, we actually had a time frame to implement. That may be the case in this situation. We may have an asset class that needs more time to get there. Concurrently, in February, the actuaries will have the new actuarial assumptions. But as I mentioned earlier, we're already talking to them, so there should not be any surprises that they have different assumptions than what we've been using to model. But that is your formal adoption will be on that February 2020 meeting. So I wanted to bring to your,
I've got green on my side. Ready?
Yeah.
Okay. So Geraldine, I just want to make sure that I didn't misunderstand what you just said. I thought what I heard you say that in February, when we adopt the new actuarial assumptions, those recommendations that are coming to us shouldn't be any different than what we've used through the asset study.
yes, modeling, we should be using similar assumptions such as inflation.
Yeah, that's kind of, I don't understand how that works. I mean, what happens if between November and February, there's changes to what the actuaries are going to recommend to us for our assumptions? I mean, it seems like we should be using the assumptions that we have. And maybe they're not the right assumptions, but I guess it's strange to me that we would be using actuarial assumptions for our asset liability exercise that haven't been adopted by the board yet. Because those could be two totally different numbers. So can you just help walk me, thank you, David, help walk me through how that's all going to play out? Because it almost seems like we're adopting them after the fact. Are we putting the cart before the horse?
Yes, so good morning or good
morning.
afternoon. So this time around, what we want to do is, as you're going through the asset allocation process, we've asked also Milliman, your actuaries, to work on the experience study, because our plan is to be done with the experience study work by the time you make the actual asset allocation decision. So all of the assumptions that would be recommended in February would be known at that time. So our plan is in November, when let's say you're faced with deciding between three various asset allocations, you will know ahead of time. If you pick portfolio 1, the recommended assumption will be X%. If you pick 2 or 3, so you will know ahead of time. So our plan is to finish all of the work and know ahead of time what the recommended assumptions will be. So if you remember last time, there was a sort of, if you look at when you adopted the asset allocation, I think the board, I don't know, maybe were under or at least the portfolio was presented as, I think we were expecting a return of about 7.4. But by the time we had the discussion over what the investment return assumption should be, As you know, we ended up at a lower place. So I think this time we want to try to make sure that we're all in agreement ahead of time, so that you know when you're faced with a decision of how to invest the assets, what will be the recommendation from us as to what to use as an assumption. So we've kind of we've sort of pushed way ahead of schedule all of our work on the review of the assumptions.
Harry, am I still, okay.
Yes,
Chris can go ahead and,
Oh, I was just going to add, we can adjust this schedule, because the goal here is to perfectly dovetail with the actuaries. So I know Paul raised a question about, well, hey, what about the inflation assumption? So we don't want our assumptions to differ. We want to be on the same page.
right.
And be interlinked. This, for the new board members, this is actually the first time we've tried to dovetail them, which is wonderful here. It was always a separate process.
Absolutely.
So we can change that, whatever the actuaries need.
It seems to me that if we're going to use the new actuarial assumptions, we might as well adopt those at the same time we're adopting our asset allocation targets. And that's probably different than what we have on our work plans. But does that make, for me personally, that makes more sense instead of doing it after the fact, even though they're what we've used. I mean, then it just kind of becomes pro forma.
And from our perspective, the one assumption that matters the most is inflation.
Right.
And that one, the board could certainly adopt it ahead of time. We would need to talk with Milliman, make sure we're all in agreement, but that would help because if you remember last time, it was one of the variables that basically drive our assumption lower. So we could simply do that ahead of schedule.
And none of, whatever assumptions we're using aren't going to change depending on the portfolio that we choose
No.
either. We're going to use the same assumption.
Correct. So if we go down that path, then if you want, the two main economic assumptions would be sort of known ahead of time. And then in February, kind of what would be left would be all of the demographic assumptions. We would see.
And that wouldn't necessarily change what we decide to do in the asset allocation.
That's correct, yes.
Then I'm fine. Okay, never mind.
I see, my sense is that there's agreement that that's the right path, that they would be along parallel paths. Because the staff, when Joy and I had an initial meeting with Scott and Josh and a couple other staff members, that was presented to us, and we thought it was a prudent way to go. So, okay, you have, understand, we're in agreement now, so we can continue. Thank you for that clarification, Dana. Thanks. And thank you, David Lamoureux. Geraldine, back to you.
All right, thank you. I wanted to start out talking a little bit about investment beliefs that have been well vetted by the board, and they are the foundation for this study. We'll just assume these are fundamental to what we believe and what we want to do. So diversification, obviously, we believe mixing different assets makes sense, as one will be more defensive, one will be more return-seeking. We will include those in. We believe in an illiquidity premium. As a long-term investor, we think we can invest in the private assets that have a longer time horizon, so we will make sure we have those asset classes included in this study as an assumption that we believe that's the best thing for the fund. Regarding meeting short-term drawdown risk, given that we are a mature plan, that we have negative contributions, about $500 million a month, we will consider protecting on the downside since this does significantly impact our ability to fund our benefits. So again, we're going to build that in and give you some analysis on different scenarios and how we can protect that. So what is this study? It's more about a process than an actual let's get the right answer, because there's actually not exactly a right answer. It's about a dialogue on what's important to you as a board and in your responsibility to fund benefits. It's about taking a very long-term view. So some of the discussion you heard with the economists, it's a little bit more short-term. We are looking out 20, 30 years, and we're working with the actuaries. That's why their viewpoint can be ours. Now, we'll set some more short-term targets in the end, but our view needs to be out in the long term. And doing scenarios, you saw the big drawdowns in 2008, 2001. We need to do scenarios that we are at least considering that. We can't totally mitigate that, but what we can do to mitigate that is really important to the study. What we will not be discussing, that you will discuss, In many other agenda items, including today, we won't be talking about short tactical tilts to the portfolio. That's not what we're talking about. We won't be talking about specific strategies or managers, and we won't be selecting benchmarks. Ours are more long-term benchmarks that are proxies for the assets that we're discussing and modeling. So Christopher Ailman showed you this earlier, and I wanted to bring it back because it shows how our beliefs have been implemented in the portfolio. So we started with 3 different asset groups in the 80s, as Chris explained. Now we're up to a point where we've added private assets, again, our illiquidity premium. We've added risk mitigating strategies, which is how we're protecting and mitigating risk for drawdowns. So here's our current long-term targets that were set at the last study. You can see how we group them in categories. So equity is more of a growth focus. We have inflation protection and the real assets. And then we have a category that is the risk mitigating strategies. We do have a fixed income group, which actually includes fixed income and cash, right? That's more of an income stream and a little bit of diversifier to the equity risk premium. So I'll be the second person to say it today. As Christopher mentioned earlier, this is really the most important decision you will make. Actually, I'm the third person. I think Harry already said it. Studies have shown that, returns will vary mostly based on this decision you will make. This will be the biggest decision in helping funding benefits. So we're going to be actually sending out, just for your reading and background, in between the next meeting and this, some reading materials for you to read actually about all these studies and help bring you up to speed in that area. Okay, I'm going to turn it over to Josh Diedisch for a little bit more quantitative aspect of this study.
So I'm Josh Diedisch, and I lead the risk team here. So Geraldine and I, work together on this study. So the purpose of this slide here was really just kind of to give you a more concrete example based on our experience. We will repeat over and over again, the importance of the strategic allocation and how important it is for determining the return. And this is just sort of been our experience as a portfolio over the last 30 years, that 95+% of the total return we've had over the last 30 years is explained by the strategic allocation. And that was really just something. The couple slides that I have are really sort of in the spirit of trying to provide a little bit more concrete examples of some of the things that we talk about and that are important in this study, particularly at this kind of early stage of just talking about the process. So one of the things that we'll talk a lot about too is this idea of art versus science and uncertainty. And so one of the things that I wanted to point out as an example here is, we will do our best. We'll work with PCA and Makita and use sort of sound principles to come up with assumptions and sort of use the best techniques that we can come up with and go through the process and use a prudent process. But one of the things that we can't control is what the market returns actually are, what the market provides. So we'll go through a prudent process and develop the allocation, but how the market actually performs over the long term is pretty important. And so, as just a more specific example, if equity returns come in about 1.5% below our expectations, that's roughly equivalent to cutting the equity allocation in half. So just to kind of give you a sense of the scale of the importance of sort of what the market does relative to the decision you're making with the asset allocation. I think sort of recognizing that there's a lot of uncertainty. We're going to do everything we can to recognize that, but there is significant uncertainty in this whole endeavor too. So this is probably the most famous picture in finance. So anybody who's taken an investments class has probably seen this, and you get some really arcane arguments about some of the details. But as a conceptual sort of framework, I think it's really helpful to illustrate just a couple basic kind of principles that we talk about. One is the idea of this trade-off between risk and return. And so what this shows you is some really basic generic numbers of two assets, if you make some basic assumptions about risk and return, in order to increase return, you have to take more risk, and it's something I think we sort of recognize, and it's embedded in our beliefs as well. So there's that piece of it, sort of just the trade-off of risk and return, and that's what this curve shows you. The other part is the idea of diversification, and that one can be, it's really sort of an intuitive idea to understand that, you want to diversify, you don't put all your eggs in one basket, that sort of thing. This gives you a little bit more concrete example. If you zero in on that area of the red box, what you're actually seeing is that there's actually a sort of point where you can decrease risk and increase return. And eventually you get past that, and to continue to, increase your return, you have to take on more risk. But when we talk about just the real basic principle of diversification, this is sort of what it's about. It's finding that right mix of assets that gets you the best return for the minimum level of risk for that level of return. And that's something we're going to spend a lot of time on, particularly in the latter half of the study. So this slide and the next one, these are really more sort of, again, concrete examples of, why we talk about diversification so much. So what this shows you is equity market returns. These are 10-year equity returns for different countries going back to 1900. So you can see sort of across countries, there's quite a bit of dispersion. The rectangle, the boxes there, about half the time you're within that box, and the line in the middle is the median. But you can see even on a 10-year horizon, there's quite a bit of dispersion within the countries and across the countries. That's sort of the basic point here. And then a similar chart, but looking at it a little bit differently, it's taking those same 10-year returns for different countries over time, and you can see the dispersion across the country. So if you look at that and that looks like a jumbled mess of colored dots, that is really what's going on. And sort of the point of this is just to show, in one given 10-year period, a country can be at the top of the range when you compare it to other countries for equity returns. In the next 10-year period, it may be at the bottom. So, in the last study, we shifted to a global market weight portfolio in the equity portfolio. This is a part of the reason why, but more broadly, you could do a chart like this and include all sorts of other assets in there, and you would have a similar picture where over time you'd have all these different assets doing well and doing poorly at different times, and we don't know what that's going to be in any short sort of time period. So this is sort of, kind of the concrete example of what we're talking about when we talk about diversification.
Thank you, Josh. This is our funded status over time. The solid obviously is where we've been, and the dotted is projected based on the funding plan that was approved by the legislature in 2014. One thing we wanted to draw your attention to is there's really, based on what Josh was just saying, there's actually ranges around what we're going to expect in the future, right? It's possible it could be higher one year within a range and lower one year, so that it won't be this nice smooth path. Another way of looking at the funded plan is contributions come in, and I think you had the fountain that Christopher Elman showed earlier. In the funding plan, they expect 60% of the assets to pay benefits to come from investment returns. And that is the assumption of a 7% investment return over time. So again, there's a lot of volatility. We will do our best to model it, to bring it to your attention so you can consider what it means to the funding plan and our ability to pay benefits. So over the next year, this definitely is a team approach, and I want to talk to you a little bit about what they're doing. Obviously, the investment staff, Josh and I are on the investment team, obviously working with Christopher and Scott. We also then work with the actuaries and the fiscal services team to make sure we understand our cash flow needs. The actuarial staff, as you heard earlier, will concurrently be going to the board with their recommendations, and now it looks like they're move up their inflation discussion. The investment committee consultants will opine on staff's work. They give us input on our work, and we'll do, analytics as you need to get comfortable and to help you make your decision. And obviously, you as the investment committee are really the biggest decision makers and most important. So we're hoping to bring you enough information that you can make the best decision. As we mentioned, it is the most important decision. So we can take questions at this time, or if you wanted your consultants to give a few comments.
Yep, thanks Geraldine, thank you, Josh. We have Dana has a question or a comment. Dana?
So Geraldine, it sounded to me as you described the different roles that each one of these departments is playing. And I know that it's going to be collaborative, but it almost sounds like the workflow goes from point A to point B to point C. But is it more collaborative than that? I mean, are you meeting on a regular basis with the consultants and actuaries and financial services and?
Yep, quite frequently. Actually, I would say we have formal meetings, which are less frequent, but we have frequent interactions. We'll have emails with the consultants, hey, we're thinking about this, what do you think about? We sit with David Lamra and his team quite a bit, so it's actually a very fluid, and that's part of the reason the smaller team is more nimble. We're able to do that, and obviously then we pull in Chris and Scott, and here's some thoughts we have, so yes.
Paul?
Thank you. So this sounds really good, and I'm especially pleased to see that we're going to be integrating the experience study and getting the inflation assumption done in a concurrent way. So when Chris was talking earlier, and I'm going to go back to that cruise ship analogy, and he said, what we've got is we've got some point out in the distance that we're aiming for. And it's not short run. So what I want to get some clarity on is how far out is that point in our work on the asset allocation? Because I may be wrong, but as I recall when we adopted the last asset allocation, knowing full well that this is a cruise ship that doesn't spin on a dime, we adopted asset allocation that I don't think at the time had steps in it. I may be wrong. But I think it said, we were going to be private equity 13%, we were going to be RMS, whatever it was, 9% or something like that. And we didn't kind of account for the fact that our expected performance over the next several years was going to reflect the fact that it was going to take us a long time to get there. And so, in fact, what we did, even if we accepted that our return assumptions were accurate, our expected returns for the whole portfolio really would be different than they would be if we were able to, on a dime, change to that asset allocation. So I'm wondering, are we going to, because obviously what we do is now that we're going to be looking at our returns integrated with our actuarial and funded status, are we going to account for the fact that actually, while we're turning that cruise ship around, our expected returns are going to be different and our risk is going to be different than what it would be when we get to that target point?
Your question is timely, actually, because even just right before the meeting today, we were sitting down in the cafeteria talking about, among other things, this question. And so to your question about the transition to the long-term allocation, in this study, something we're going to do differently than we did last time is model any of those types of changes on a path to whatever that long-term allocation is. So all of the modeling that you'll see, the metrics, the return metrics and risk metrics, everything will reflect a path to whatever that allocation is. And that'll be a collaborative thing that we work together on with the consultants, the portfolio teams, and the specialty consultants all sort of together to figure out what those reasonable paths are and account for that in the modeling, this time explicitly.
That sounds great. Thank you very much. Any other questions or comments from the committee members? If not, I would like Alan and Stephen and Mika, if you could, on INV 178, the staff has outlined the process over multiple months. My assumption is you agree with that timeline and process and the steps that we're taking, or any other comments that you might have on this initial presentation.
We think the process, particularly what Josh just indicated, that there's going to be a path on implementation, is a great improvement. We think this is doable, but particularly for the new members of the committee, I just want to point something out using the analogy of the cruise ship or the oil tanker, which I prefer, even though it might be politically incorrect, because it's a much bigger ship than a cruise ship. And
Alan, in my analogy, we're the cruise boat. The other pinch is flying across the river, it's the old thing.
okay, I would once
Hey, that's my retirement certificate. I can say that, right?
I'm not going to go there. There's no upside to getting into that discussion.
They're your client too.
But what I would urge you to focus on is, yes, it's a cruise ship and you have that one line, but in the interim, there can be a typhoon or a hurricane. And we're going to spend as much, if not more time on what happens during those events than that average event, because you have to live through those bad times, and focusing on that and debating that and discussing that is a really important part of the process.
Our hope is that the RMS will work perfectly during those storms.
To the extent that you want to use 1 month.
No, multiple months.
December was a great example of you doing some strategic planning and getting paid for doing that.
Thanks, Alan. Stephen or Mika, any comment?
Thank you. One thing, most important thing I want to highlight is not only do we concur with staff's sort of recommendation on the process that you're going to go through, but working on lots of other funds across the country would say that this is clearly sort of a best practice in terms of how boards and committees should be looking at asset allocation. And I would also encourage the board, as I know you will, because there's no shrinking violets on this board, to ask questions along the way, because the process is only as good and robust as you make it. And so this I'll be the fourth person to say asset allocation is the most important decision you have as a board. You do it once every few years. So we'll be encouraging a lot of questions along the way. And I think the more dialogue and integration there is between the board and the staff on this topic, the more likely the outcome is better for all. I also want to highlight that when you're adopting an asset allocation policy, you're really making two decisions that are long-term. The weightier one, and the one that we're going to focus most of our attention on, is you're ultimately determining in a general way the amount of risk that you're willing to accept in the investment portfolio over time. And I intentionally use the word risk instead of return, because the reality is all of us are going to be much more confident in estimates of risk associated with asset classes and investment policies than we are about returns associated with those policies. Because of the tyranny of the accounting industry, you have to sort of mark your fund to market periodically. The reality is no one can forecast returns going out 10, 20 or longer periods with a high degree of certainty. So that's just something to bear in mind as you look at numbers from us with 2 or 3 significant figures attached to them. There's naturally a lot of false precision involved in this process. And I'll conclude my comments there.
Thanks. Sure, and then we're gonna, I think if no one else has any comments, we'll break for lunch after this.
The consultants work for you. And I just want to underscore that. In this process, we'll be independent. We'll work with the staff. We will not always agree with the staff. And when there is a dispersion of opinion, we're going to share that with you, even if we end up reconciling our differences. So you know that there's been a really healthy dialogue and debate among all the parties, because it really is an art and not a science. And you need to understand how the proverbial sausage was made.
Thank you. Okay, seeing no one else in the queue, we'll break for lunch until 1:15. We'll reconvene at 1:15.